that brings me to our next panel discussion, and this time we're going to be talking about why is the Singapore market a bright spot for investors. If you joined us last year, we did talk about Singapore stars, but this time we're really delving into Singapore stock market performance for the first half of this year, and to explain as well why there's always a place for Singapore stocks in one's portfolio as well as potential opportunities. So for this panel, may I invite on stage Gerald Wong, CEO and founder of Beansprout. Next, Marcus Ng, Vice President, Cross-Asset Listed Distribution, Asia Pacific Global Markets, Societe Generale. Hi, Marcus. Jeff Howie, Market Strategist, SGX Group. Song Seng-Woon, Economic Advisor, CGS Securities. And R. Sivanethi, Senior Consultant, Editorial and Investor Education, CS, and ex-Senior Correspondent. Welcome, gentlemen. So welcome once again to MooFest 2024. It's been a year since our last MooFest, roughly, and I remember last year we were covering the topic on Singapore stars as well. Jeff and Marcus, you joined us for that. But I think this time around, with the uncertainty and also volatility that remains, and also with the global election space, not just with the changes in Singapore, but internationally, I think we're always looking for new opportunities potentially, and figure out what are the strengths that remain within the Singapore market and also its characteristics. So with that, and before I start, I would like everybody here listening to panel 2 to really type in your questions as well, because we'll answer some of those with the QR code at the end. Okay, I'm going to pick out some of the audience questions. And so with that, I'm going to start with this question: where do we stand now? And what is the current status of the Singapore market position amongst the backdrop of global uncertainty? Song, let's start with you.
Where are we in the current cycle? I suppose the good thing is we are still, after so many years of talking about recession, global, I mean, we still have the inverted yield curve, but we have forgotten all about that now. It seems that we are still pretty resilient. So for an export-oriented nation, Singapore, it should be fairly supportive in terms of it's kind of like canary in that cave. If the bird is singing, okay, like occasionally it tweaks a little bit, but generally been singing primarily because the regional economy, broader global economy appears to be still holding up pretty well, despite the series of interest rate cuts, which looks like we're about to see more central bank reversing. So against that backdrop, I will still say we are in a nice sweet spot here in Singapore as a proxy to just what's happening around the world, despite what we talked about earlier on risk, which has been the case for the last few years now. So I'm pretty confident.
Absolutely. Jeff, anything to add to that?
We've come into the year, okay, from a global perspective, with the most dire, lowest outlook for global growth in the next 5 years that we've had in many decades. So for this reason, you've got a lot of long-term structural drivers going on at the moment. You've got big countries, big parts of the world, Europe, China, the US, all basically using or leveraging industrial policy off to target specific sectors. So we've got this reindustrialization, as Landfall call it, going on in the world, and that's meaning a new paradigm in terms of structural growth. If you've got if you've got this geopolitical fragmentation where you have to build up your supply chain resilience, provide for economic security, basically build up your sustainability bank, you need to invest a lot, and therefore you need decent interest rates. So, so from a structural perspective, looking forward in the next few years, interest rates come off a bit, but nowhere near as low as where they have been. Then you start looking, as Sung was saying, talking about the cyclical drivers at the moment. We came into the year very focused on interest rates. That has quickly morphed into a focus in terms of the US being able to pull off a very smooth landing. That is why you've got Singapore outpacing the ASEAN region this year. We're up 8.1% on a total return basis. You can just basically look at what happened in the terms of the tradability of the market last week, and it provides a little microcosm for what's happened this year. Your banks were really strong because a smooth landing, obviously you keep those rates higher a bit longer, that supports net interest income, but it also supports the ability to grow your loan books and also supports your non-interest income wealth management activities like we've got, you know, with Moomoo obviously benefiting from that focus on wealth management as well. And then it's also impacting the high growth elastic or the high beta stocks such as your shipping stocks like Dyna-Mac, like Marco Polo Marine, like Pacific Radiance, like Mermaid Maritime, and we saw those stocks obviously very strong at the moment as well. So this is the thing. You've got really interesting long-term structural drivers. You've got a very fluid outlook for short-term cyclical drivers, and this is all providing a huge wave or element of tradability in the markets, which I think is really exciting.
Thank you for summing up those points. Now, that brings me to my next question for you, Sivan. It's really about the typical characteristics of the Singapore market and what stands out for you in its evolution in the present.
Okay, thank you for having me on this panel. These guys are all practitioners. I'm just an observer. I'm a sideline commentator. So I'm actually quite honored to be invited to sit with them. But I started work as a journalist in Business Times in 1992, covering the Singapore stock market. That was 1 year before Singtel listed and we had a Super Bull run. CPF was liberalized back then. I don't know if you all can remember that. Back then, the Singapore market was reputed to be a very good defensive play, right? The word defensive means that because of the good dividends that are paid, you can expect prices not to fall too much in times of high volatility. But by the same token, you can't expect very much upside as well. So that led to the Singapore market being described as boring. But I always felt that in any market that you're in, as long as you are familiar with the stocks, you can make money, right? Whether it's here or in Malaysia or in Thailand, as long as you are willing to put in the effort to look at the stocks, to do your homework, money can definitely be made, boring or not, right? So and I think that reputation still extends till today, right? The banks pay fantastic dividends. We have the REITs. You've got SIA just announced very good dividend as well. So the dividend play and the defensiveness of the Singapore market remains the same, I think, over the last 32 years since I started covering the market.
Thank you for that. Gerald, from Beansprout's perspective, what have you seen amongst the Singapore investors? And also just adding on to the points of the evolution aspect of Singapore market.
I think the dividend aspect still remains very relevant today. Since you mentioned Singtel as an example, they announced a total dividend of 15 cents for the last fiscal year. So translating that to the share price is actually a dividend yield that is above 6% and looking very attractive. But I think on top of that, we have seen Singapore companies evolving as well. So if I were to look at Singtel, I think we are all familiar with them as a provider of our mobile services, our broadband services. But many of us here may not know that Singtel is now heavily involved in data centers. I think that was what drove the share price to a 52-week high last week. Likewise, if I look at the top performing stocks in the STI in the first half of this year, many of them have actually evolved their businesses. ST Engineering is another stock that is also at a 52-week high. They also recently announced investments in data centers. So I think while the companies still offer attractive dividend yields, they are evolving their businesses to keep up to date with some of the key trends in the market. And apart from the companies as a platform that often interacts with retail investors, we see that investors are more keen to find out about these stocks as well. So whether is it through the webinars that may be conducted, through SIAS, through Moomoo, through Beansprout, we see that there are a lot of questions being asked by investors about some of these names. So it's not just about hearing what are some of these names that might be attractive, but investors are doing their homework to understand what are the opportunities as well.
Doing the homework and the research for sure. Now, Marcus, I want to bring you to this point about, is there a strong revival interest expected in the second half? And how is, like what Sivan mentioned, how is boring actually a good thing, instead seen as a stability point, instead making it a bright spot then for investors here in Singapore?
Well, I mean, I was here last year in MoveFest 2023 as well, and we were talking about how Singapore is boring. So if you ask me in 2022, 2023, and ask me whether Singapore stock market is boring, I would say yes, kinda, to a certain extent. But in the first half of 2024, it's definitely not boring. The first half of 2024, we've seen amazing moves by some of the Singapore stocks. You have your DBS, your Singapore banks breaking out of their 2-year range. I mean, the first time I've seen DBS hit like $37, $38. So that's something new in the last 2 years. You have your Yang Zhejiang shipping stock, massive bull run. I've never seen such a J curve on their stock price. Sembcorp had a spectacular run in the last year. One of the star performers last year when we were here as well, Sembcorp, and now it's in the correction phase. And you have your REITs and your property development counters taking quite a hit. They are in a bear market. So there are opportunities when there are these such sectorial moves, right? So it's definitely not boring in my universe where SocGen, we are a product issuer of a leverage instrument that we have listed on SGX, where you can trade both directions of the market, long, short, on the underlying single stocks, Yang Zhejiang, Sembcorp, Keppel Corp, DBS, etc. So we've seen increased activity on the short DLCs as well, and the long DLCs as well, depending on where the counter is moving. Because when Singapore stock trends, it does trend quite nicely over a period of time. And being a very institutionally driven kind of stock market on the SGX, this is a comparison to the Hong Kong stock market, which SocGen we also cover. This is a different market altogether. Institutional brings a bit of that stability and a bit of that predictability. Within a certain range of certain stocks, you know that there'll be buyers coming in, etc. But when it comes to the Hong Kong stock market, which we always see on a day-to-day, it's a more retail-driven market, and it can be quite crazy. It's frenzy, news-related. So I think it's pros and cons. So definitely this year, first half 2024, has been very exciting for the Singapore stocks as well as for Singapore stock DLCs in terms of the tradability. Let's see for the rest of the second half of this year whether this volatility can continue.
Jeff, I want to know what you think related to Marcus's points.
I would invite everybody to, if you want to see how exciting Marcus's world is, go into the platform, the Moomoo platform, and type in the code. What would you type in? You type in 2 codes, because the most traded DLCs at the moment, one is a 7 times leverage Hang Seng long or call option. The other is a 5 times Alibaba long DLC as well. The DLC, I think it's DEQW for the Alibaba, and I think for the Hang Seng one, it's ECSW. So if that's the most traded DLC at the moment, okay? So if you want, just give yourself a little bit of homework, a little bit of exercise this week, and you want to see how the DLC actually moves in relation to the Hang Seng Index, traded through SGX, type in the code, what do we say it was?
You can just find
ECSW. ECSW.
If you just type DBS 5 times long or Hang Seng Tech 7 times long, you should be able to retrieve it.
Yes, and you can search that for yourselves. Just have to type it in the app itself, okay? So before I go to my next question for both of you, actually, I do want to go out of Singapore for a little bit. And I want to pick the brains of Song and Sivan a little bit more on this. How has Singapore, from a macro scale, stepped up and also learned from our counterparts within APEC? And I'm talking specifically with the revelations within Japan and China lately.
For those of you who have followed articles and comments in the press about reviving the Singapore market, you might know that a lot of suggestions have been made. Among them, getting GIC to put CPF money into the market, getting the big Temasek-linked companies or government-linked companies to list. All of these, in my opinion, won't really work. They might provide a short-term solution, but in my view, not great. The one suggestion that stands out for me is what Japan did. Earlier on in the previous panel, the Japanese gentleman spoke about corporate initiatives that they took. Basically, they have shifted the onus of bridging a valuation gap. That means for shares who trade, for shares which trade below their book value, they put the onus on the companies to disclose measures to bring their prices up. If your share price is trading well below your asset value or your book value, then you jolly well do something about it. So that's essentially the approach that Japan has taken. And the SGX lady who was here as well also mentioned, or rather the previous panelists also said that this might find a place here in Singapore. So I think that's the only suggestion in my view, which is also being studied by Korea as far as I understand. I'm not sure whether Korea has implemented it yet, but Japan it has worked. So that's one suggestion which I think might find a place here in Singapore. And I'm sure that the authorities here are studying it. I'm very sure that MAS and SGX people they're actually very capable people, and they are definitely studying this. So I don't know, maybe in a month or 3 months or 6 months, measures are sure to be announced. I'm positive. I have no idea when, I have no idea what they are doing behind the scenes, but I'm sure that they have sat up and taken notice. All right?
Song, you look like you have something to add on before I go to Jeff on the next question, also something related to this. Perhaps we can start with you.
Somewhat related to that. I suppose, again, is from a macro side, putting on my macro hat. I think we must remember, while we're talking about Japan market or Korean market, Singapore is a freaking tiny little island city-state. So you don't have a big, a kind of a backwater kind of to depend on. And how small it is, put everybody inside there, 6 million, including, say, the babies who can't trade. So it is a very, very tiny economy that generated business really from trading goods and services with the world. And how we, therefore, just think, if every tiny city has their own market, it's that kind of a scenario. So there are challenges, not to say being a tiny, small city-state cannot have its market. It's really, as Chief say, and what Jeff will jump in later on, what we can do to add a little bit more variety or just volatility to the market. But perhaps we take too well care of our retail investors, but we can go down and argue around that. But really, for Singapore case, it's really very unique. So often we compare city, whether it is or country, most expensive city for expat to live in, or country, this is a tiny space. If more people want to live and work here, then obviously, unless you can live offshore, there are limitations on that side. So that's really my only comment, but I'm sure Jeff is itching to add more.
Jeff, please.
Yeah, I think there's a pretty big stock market in terms of the number of stocks. You have, let's say, 120 stocks that are covered by at least 3 analysts, okay? That's a very vibrant part of the market. You have another, let's say, 300 stocks that don't have that critical coverage in research. So working and growing the distribution of research on the stocks is super important. There's stocks in there that are incredible stories. Bengquang Marine joined the SGX watch list a year and a week ago. It's undergone the structural transformation to get its books back in the green. 11 billion Sing profit before tax last year. Another 11 million Sing profit before tax for the first quarter of this year on the basis of a disposal. Turnover, liquidity, up threefold from last year. Our second best performing stock across the whole stock market this year. Soil-Built Construction Group, its turnover is up tenfold from last year because it's landed a great contract worth, I think, 648 million Sing. Its order book's now above 1.2 billion for the first time ever. They don't have coverage, but it elicits interest. AGT Partners has invested as an institutional investor into Beng Quang Marine. This is a stock on the watch list, and it's taken its interest up to 7%. So these are the kind of small stocks that we really need to focus on. And it's interesting because he was sitting in the front row, now he's left, Julian. There's an organisation that I'm just so grateful that Moomoo has really thrown its support behind as well, and that's CIAS. Sivan's with CIAS. Gerald works a lot with CIAS. We've done so many CIAS panels together. This is the little microcosm that's a big part, 25 years been going, but at the moment being very focused on engaging the investors with these small companies that do, like Sivan was saying, want to reveal what their capital plans are, how they are monetising their assets better on their balance sheet to grow their business and, as Gerald said, evolve.
Yes, and on that, I'll get to you soon, Gerald, but I do want to know Marcus's points as well, because my next question was actually what you talked about, Jeff. It's also discussing what changed, what remains, and also what is unexpected based from like the discussion we had a year ago, for example, on this same stage. You know, what has surprised you even perhaps regarding the Singapore market? Marcus?
So for last year when we were here in MoveFest 2023, I mentioned that for us, SocGen, we issued DLCs, leverage certificates on the STI, Straits Times Index, offering you leverage exposure for 5 times or 7 times for both long and short exposure. So 1 year on, I think that has grown quite well in terms of the activity on the STI DLCs that we have. So for me, I want to go back a bit to the earlier discussion on, like what can really move the Singapore stock market. Well, for me is I don't really see the possibility of your next Apple or your next Tesla being listed here on the SGX, etc. And so for me as a products guy, I come from the angle of product innovation. I believe that product innovation will help drive the Singapore stock market to the next level. All right. So product innovation, whether is it like the payoff, whether you have different kind of leverage, leverage or auto call or discount kind of payoffs on the same underlying asset of your DBS stock or your OCBC stock, because when people trade those instruments, the issuer will hedge on the underlying stock, and that helps to spin the wheel to drive further liquidity into the underlying stock market. All right, so that's one thing, more product types for investors' portfolio on the Singapore stocks. The other aspect would be to have products that offer investors more access to regional or global asset classes, right? For us, we have a very vibrant ETF market in the SGX, but not many people are that aware of it yet. You have a Gold ETF, you have your, last year, I believe the most actively traded ETF was the Hang Seng Tech ETF. So these kind of products, ETF, DLCs, that offer you exposure to regional stocks, which I believe will be more volatile, will be more exciting and more sexy than your DBS stock or your OCBC stocks, will help to drive that activity in the Singapore stock market. Very soon, I hope that we can see US stock trading on the US, on the Singapore stock market, right? Right now, we have Thai SDRs that are trading on the Singapore Exchange, offering you exposure to Thai stocks. Hopefully, one day we'll have US stocks, because this what I know is it's the first thing on everyone's mind, right? Yeah. US stock trading during Asian hour on the SGX. That would be something exciting for the Singapore stock market, to get retail to be more engaged in the SGX again. And I think that is an easier win than trying to lobby for the GIC to put in money into the Singapore stock market.
Well, you and I can do that. We can just start doing a door knock appeal. No, seriously, we should. Of all the upstream tech companies that actually do have either industrial business park here or some of the big consumer names that have a shop front, why don't we do a door knock and just pretty easy to turn on the machines and have a one times leverage DLC on all those companies?
I mean, sometimes the best ideas come from panel discussions, right? So I'm really enjoying this conversation at the moment, but I'm going to remind the audience to submit your questions, okay? Because I want to hear from your side as well and keep you engaged within our conversation space at the moment. So Marcus, you brought up some strategies or instruments potentially, right, that they might want to look at. So before I go back to the previous questions, I do want to ask Gerald on that topic alone, coming back to home ground with our Singapore residents here in the audience, what kind of alternative investment products then may come into play? You know, we're talking about even about CPF, and you mentioned dividends just now as well, but let's look at the whole ecosystem of the Singapore resident strategy.
I think what has also surprised me about the Singapore market over the past 12 months is that we have seen a lot of new product launches. I think we focus a lot of the conversation on stocks, whether it's mid-cap, large-cap, blue chips. But like what Marcus mentioned briefly, what we have seen over the past year would be a lot of new product launches that we can get through the Singapore market as well. So DLCs would be one example. The other asset class that we get asked very often would be ETFs. Even within ETFs, there are 5 REIT ETFs listed on the Singapore market. The question that we commonly get is then how do I even choose amongst these 5 REIT ETFs? You've got a number of China-exposed ETFs in the Singapore market as well. So for those of you who believe that there's going to be a recovery in China, those are the different products that we can potentially look at. And even within ETFs, we've got passive ETFs. And last year, we saw the first active ETF for offering investors exposure to the Japan market. Olivia, we did a webinar on Singapore depository receipts as well. So that was when Thailand SDRs were launched in the Singapore market, and now you can get exposure to 8 blue chip Thai stocks through the Singapore market. So I think whatever your risk appetite is, whatever your investment objective is, we are seeing a greater range of instruments being available to investors. And I think what we try to do at Beansprout is to offer you with these insights to be able to understand more about these products and then to make a better financial decision.
Absolutely, and we're definitely aligned on that, you know, on the investor education space. Everyone on this panel, actually, the emphasis on the research and really understanding your own homework first before you make your own personal decisions. Now, let's go back to the macro questions, okay? And we'll come back to more instrument questions later on. What can we expect for the second half and beyond in terms of global opportunities using local currency, perhaps, and how will Singapore remain competitive within this space? Perhaps Song or Jeff would like to take this first?
What potential impact could increased tensions between global powers have on Singapore's economy before the market? Okay, because the cues on the economy will determine what happens to the market. And at the moment, the issue with the political tensions is you're having a lot of economic fragmentation. As we said, you have the CHIPS Act in the US, the semiconductor bill in Europe, you have the big massive trade-in program going on in China with the Quality Forces New Doctrine. This is all creating a lot more output. Is it creating more efficiency? Not necessarily. A bit of overlap and doubling up, as you can imagine. But what it means is all these countries are racing to move upstream. So you're going to have potentially more commodity volatility, and you're going to have a lot more focus on moving upstream, particularly in tech, where it's more to do with, that's why NVIDIA, as you mentioned before, Qualcomm and so forth, has had so much focus, because it's right in the very upstream of the whole tech supply value chain, the design of chips versus fabrication versus assembly, testing and handling, which we're really good at. So what we have to do if we are downstream is look more at expanding capacity and improving our productivity so we can basically be processing more of the output that comes through the value chain. And that's exactly what we've been seeing in our tech sector and our tech stocks like what AEM, UMS, Franken Group, ISDN, Global Invicom, Grand Venture Tech, Broadcom. This is what they've all been doing.
Song?
Okay, from a macro side, obviously plenty of things we're all looking out for. We just had the change of government in the UK. How long the new leader, honeymoon period will last, we don't know, because there are plenty on its plate to deal with. Over in France, we'll see what will happen on that side. So as we speak, all these are still taking place. The backdrop really is part what Jeff was talking about, that volatility coming from just uncertainty of perhaps new government, of their fiscal priorities, because end of the day, we're still talking about what's the possibility of interest rate direction, and that also depends not just on what the central banks see of how economies are doing, in particular whether consumers are reining in their spending because they're higher for longer, and the higher for longer cost of living and interest rate it should take some wind out from consumption, because if it doesn't, then may be good for company and earnings, but could be not so good from an interest rate front. And on top of that, we have that uncertainty coming from fiscal priority, which would also exert pressure on balance sheet of government and interest rate, and therefore bond market expectation as well. So, and obviously, the election to come in November, we'll see. But elections generally are good in that they create more jobs, and that can lead to spending as well. So yeah, plenty to look out for, and particularly all these will obviously drive earnings and earnings expectation.
Understand. Now, Sivan, I do want to know what you think regarding this based on Jeff's and Song's points, right? Like just coming from your experience and also looking from a commentator experience as well, right? Like what is the lens you're looking through for these particular points going into the second half as a time horizon?
Right now, the US market is mainly looking at when interest rates are going to be cut, right? So that's the main number one macro, or whatever you want to call it, consideration. And currently the thinking is September is the first cut. That's what the futures market is pricing in, high probability of a first rate cut in September. So if interest rates come down, companies that have got large borrowings should benefit. And that would, for me, that would be the REITs. Of course, bonds will also go up, but our retail bond market is not very broad here. So I would think that, from my point of view, the main beneficiaries, second half or towards the end of the year, would likely be REITs.
Interesting. Anyone would like to add on to that? Yeah. Well, I do want to take some questions towards the end, but I want to wrap up our discussion because it's quite interesting here to lead on to the final question I have for all of you. And of course, I'm just going to lay it out on the floor first. What if an unexpected turn happens in the market? How can investors leverage on the strengths of the Singapore market, which we covered as well, to ride this volatility? Who would like to take this first?
Well, it's the gold ETF, because the gold ETF is up something like 50% on a US dollar basis since the end of 2019, and that's on the evolution of all the geopolitical tensions that we've had over the last 4.5 years. STI itself is up something like close between 25 and 30%. So gold has pretty much been the trump asset class for that uncertainty, and that's the whole point of having it in your portfolio, a uncorrelated asset class that can help the portfolio in the tough times.
Marcus.
I think you can't really tell when when anything might happen, but you got to prepare yourself really for such volatility in the market. So with all these increased tensions everywhere, you can expect volatility to be something that will be heightened when this kind of thing develops. So for me, it's being aware of how to react when you see increased volatility. So either you have a very solid portfolio that can weather this kind of volatility, or you have certain instruments, like what I said on the DLCs, long-short instruments to capitalize on short-term volatility to protect your overall portfolio returns. Right? So for the DLCs, it's a short-term trading instrument where you can capitalize on opportunities on both a bear market or a bull market. So that gives you that flexibility and tactical readiness to capitalize on these kind of opportunities, as well as be able to gain exposure to not only Singapore assets, but regional stocks, Hong Kong stocks, etc., so that you are able to have a more diversified portfolio as well.
Great. We're going to take some questions now from the audience. Again, if you still want to keep submitting, you can do so with the QR code over here. So for this last part of our panel discussion, I'm going to actually take the fourth question that they've picked out first because Sivan actually mentioned it. Do you have any other insights on the outlook for a REIT's share price been hitting new lows? Any insights on that?
All I can say, because SIAS, we're a neutral organization, so we can't recommend, we don't make investment recommendations. But what I can say is that if you want to screen REITs, make use of the GIFT Index, okay? GIFT, Governance Indices for Trusts. When you use the SGX stock screener, which is an excellent stock screener, to rank whatever sector you're looking at, whether it's a banking sector or manufacturing or whatever, on the extreme right, you can rank by PE ratio, by dividend yield, by market cap, by earnings per share growth, and so forth. On the extreme right, you will see a column called GTI. Very few people actually pay attention to this. This is the Governance and Transparency Index. It is constructed by NUS Business School with a few other partners. They basically look at how well the company treats its shareholders, how well the board of directors is run, what is the degree of independence on the board, and so forth. So this Governance and Transparency Index, you can actually use it to screen REITs as well, but a better approach would be to look at the Governance GIFT, Governance Index for Trusts, which is maintained by Professor Mark Yuan Tin from NUS and a private investor named Chu Yi Hong. They have tailored the Singapore Governance and Transparency Index for REITs to take into account the special characteristics of REITs. All right, so sponsor-manager relationship, independence of the two, how much fees are involved, how is the manager compensated, and so forth. So the other thing is, there's no guarantee, of course, if you construct a portfolio with very good governance scores, that you will make money. There's no guarantee. But of course, there is a high assurance that you won't lose money to fraud, to any wrong accounting, fraudulent accounting, and so forth. So these are companies or REITs that are well run, well managed, good board of directors, high degree of independence, take care of their stakeholders, and well run generally. Okay, so that's all I can add as far as REITs are concerned.
Jeff.
Still a very fluid outlook. Financing costs and the impact it has on distributable income was obviously one sectorial theme we are taking into the year. But you can see that a lot of REITs are adapting to the high financing costs. We saw that in particularly in the US, where 70% of the world's REIT market cap is. You had 2 REITs beat estimates for every one that missed. Second quarter about to start, so we'll be judging that again. Next point, though, is that it's more the exchange rates that are an impact to a lot of multinational REITs with REITs all across the world. James from NASDAQ said that the majority of the reserves currency is US. It's actually around 50 to 60%, but the problem is 90% of global payments are in US dollars, and for that reason, when you've got a really strong Sing dollar and a strong US dollar, that provides pressure. Okay, so that's where the risk is going forward. Now, because of that, as I said, you've got a very fluid outlook, and you've actually got a high degree of tradability in the REITs versus investability. Yeah, we used to tout that, still tout that we've got 6% dividend yields, but your index is actually moving 0.6% every day on average. You've usually got more than 1% between high and low in the index, and that index is tradable for futures, albeit like a micro-cap stock that has no research coverage, it's illiquid. And it's one area that I think we'd love to kind of explore further, because when you look at the correlation of the IHS REIT index to your Fed fund futures with a March expiry, with a DEC expiry, there's a lot of directional correlation there that I think could help investors somewhat.
I'll
Gerald.
just add to that because it's a question that I've gotten a lot over the past 1 month. I look at Mapletree Pan Asia Commercial Trust, below the COVID lows, now at $1.22. Mapletree Logistics Trust, Mapletree Industrial Trust. So we get a lot of questions around why are the REITs falling and what is the outlook for the REITs. For me, it comes down to 3 key things that I will look at. The first is fundamental. So what is the occupancy of the underlying assets? Say if you're looking at office REITs, the occupancy in the US might be 50%, but maybe in Singapore, the occupancy rate might be still above 90%. Okay, the next would be financials. Jeff mentioned that the high interest cost is affecting quite a number of the REITs. So we need to look for REITs that do not have too much borrowing. The last would be the valuation. So it can be a good REIT but expensive valuation, or we actually see that some of these REITs, they've fallen to 2 standard deviation below their historical average from a valuation perspective. So that may actually present interesting opportunities for those of you who are looking at some of these REIT ideas.
And if you're looking for yield, there's also utility business trusts, right?
Yep. So we have a checklist on our website, Beansprout, where we provide some of this latest information. You'll be able to sieve through what the occupancy rates are, the leverage ratio of the different REITs, what their latest valuation, and do your checklist from there as to what are the REITs that can withstand this higher for longer interest rate environment in a better way.
Very helpful. Thank you for summing that up and also for the insights previously shared. We have time for about 2 more questions, and I do want to touch on this because we talk about the Singapore Green Plan quite a lot and also relating that back to the SG budget for this year. Now, we haven't talked about this particular angle, so someone would like to know how might Singapore's green initiatives and sustainability goals affect investment opportunities potentially in the coming year? Song? Perhaps from a macro standpoint first, and then we can delve into the Singapore side.
Okay. No, pass it back to him very quickly. I suppose every company or every household would have some sort of a mission statement already. So I think if you don't have one, you'll be punished. So I suppose it's given that you will have. It's really how you go about doing it. Okay, now I pass it back.
Yeah.
Yes.
We've had a fantastic 12 months before we came into this year, there was a renaissance across the world in terms of the creation of renewable assets, solar, wind and hydro. We've got 3 600 megawatt hydro plants that we're building in Jurong in Singapore. Sembcorp's involved with one, Keppel's involved with one, and a Japan consortium is involved in another. Keppel and Sembcorp were our 2 plays last year that outpaced the STI of symmetrical gains of 61% total returns, both building renewable assets in gigawatts. The solar assets, though, they have a lower irradiance level than the hydro plants, for instance. Plant load factor around 15%. It means 1 gigawatt of solar is enough to power 270,000 HDBs in a year. Now, this has all been really exciting, but this is where global politics come in. At the moment, the odds of winning the US election is Donald Trump. And see what Donald Trump is talking about in terms of his thoughts on EVs and sustainability pivots, and look how much of that interest has come out of that transition.
Yes, very interesting point there. So you brought up the global space, and so, in terms of instruments and also strategy points, right? Marcus, perhaps, Singapore and the global space, is there anything you'd like to cover within that, with the changes that we brought up, or the potentials?
So as I said, we have products on the SGX that offer you exposure to regional or even global asset classes. So for the DLCs that we have listed on SGX, the payoff is exactly like the TQQQ or the SQQQ that you see in the US, that are super popular in the US. The ProShares Ultra, 3 times long and short, leverage and inverse ETFs on the NASDAQ in the US, trades massive amounts every day. But we do know that we have exactly the same kind of instruments that are listed on the SGX in the form of the DLCs, just that we can go higher in terms of leverage, 5 times or 7 times. So I think I just want to end off, we have not much time left. For those of you who are keen to learn more about what this short-term leverage instrument can offer you, we have a presentation at 1:30, 5 p.m. later on. So do join me later for a quick understanding of what the DLCs can offer you.
Thank you so much. For more questions, but of course, that's all the time we have left for the questions. As always, I like to wrap up every panel discussion with the key takeaway. So let's start off with you, Sivan.
Lots of opportunities still in the Singapore stock market. It's not as boring as many people make out to be. Before we had this panel discussion, Song Seng Woon said, boring is good, right? So just bear that in mind. As long there are opportunities in any market, right? Whether it's boring or highly volatile or whatever, as long as you do your homework, stick to the fundamentals, and be very familiar with whatever you're investing in.
Song?
I suppose it's really at what stage of life you are in. I mean, I say boring to sheep because I may be about to be burned anytime forward as well. So boring is good from a standpoint of just have a reliable stream of investment income. So that reliability comes from sometimes just picking boring dividend stocks, for instance. So that's all I have to say, I suppose.
Jeff.
Okay, if you want to speak with some companies that also really want to engage investors and also have a vibrant market, you're able to do that through SIAS. If you want to know some of the really interesting parts of the world economy, how it translates to Singapore, Song can do this. Marcus has, as I said, a great product line. ECSW is the code for his most traded DLCs, if you want to just plug it in and see how it moves with the Hang Seng. And we've got Gerald now also conducting research with Peggy, with the hiring of Peggy from Philips. So I think Keppel Infrastructure Trust is now covered by Beansprout. So we've got a lot.
Absolutely. Marcus.
I'm probably the youngest in this panel, so I would say boring is not acceptable. All right, we have to go for upskilling ourselves by learning more than just buying stocks, learn more about what products can offer you, including the DLCs, ETFs, diversify your portfolio and not just buy and hold. Learn how to navigate the market volatilities, upscale yourself. I mean, don't go and overtrade and manage your risk properly and understand what you are trading. That's important. But upskill yourself and learn more about what products can offer you.
And of course, Gerald.
Whether you're young or old, whether you're looking at DLC, stocks, or REITs, just stay informed, stay educated about what you're investing in. If you want to learn more about them, do look up various websites, whether it's SGX Research, SIAS, Beansprout, Moomoo. We provide you with different content and insights to help you make a better financial decision.
So see you at 1:35 at the side stage. There is a portable charger for everyone who attends. Thank you.
That's what we need. And round of applause, everyone, for our Singapore panel. Why is the Singapore market a bright spot for investors? Thank you so much, gentlemen, for today.